If I had to make a call on crypto today from scratch, knowing what I know about this market's short-term strength, the bigger chart pressure sitting overhead, and what usually happens when traders confuse a bounce for a brand new bull run, I would do this very differently. Most people think this kind of market is about picking a side and marrying it. Full bull, full bear, diamond hands, doom loop. But that's not what this is about right now. This is about understanding that a market can look strong on the surface and still be carrying a crack in the foundation. And if you don't respect both of those truths at the same time, you can get chopped to pieces. It is Tuesday, April 14th in New York. And before we go any further, comment the day and date you're watching from. And real quick, if you value the work here, subscribe and comment John A.G. Best, so I know you want more of these breakdowns, because here's the setup. Bitcoin looks like it still has room to squeeze higher in the near term. That is the micro picture. But the larger structure still looks like a market that has unfinished business lower. That is the macro picture. Those two things can live together. In fact, they often do. The market rallies just enough to make late bears panic, just enough to make late bulls feel brilliant, and then it reveals what it actually wanted to do all along. That is why this next stretch matters more than most people realize. And before anybody gets too comfortable, let me say this plainly. Just because price can still climb does not mean the danger is gone. Sometimes the cleanest trap is the rally that everybody can explain. You get a breakout, the headlines improve, risk appetite comes back, altcoins start waking up, and suddenly people start talking like the hard part is over. Maybe. But maybe not. Because the best way for a market to punish the crowd is to reward them first. So let's walk through this carefully. Start with Bitcoin. On the small picture, it has done something constructive. Price pushed through a short-term downtrend, and it's now trading back in the mid-70,000 area after spending time lower earlier this year. That matters. It tells you buyers are still there, it tells you momentum has not disappeared, it tells you the market can still press upward if the floor under it keeps holding. Based on recently published numbers, Bitcoin is hovering in that mid-70s zone right now, which lines up with the idea that the bounce is still alive, even if it is not yet a full-blown escape from the bigger pressure above it. Now, what's the floor? I'm looking at that upper 60s down into the mid-60s neighborhood as the area that has to stay in one piece. If Bitcoin can keep defending that pocket, then a push into the upper 70s, maybe even that around 80,000 zone, is still on the table. Not guaranteed, on the table. There's a difference. Traders forget that all the time. A target is not a promise. It's a map point. And the market can stare at your map, laugh at you, and take a detour. But if that support pocket gives way, then the conversation changes fast. Then the move you thought was a fresh launch starts looking a lot more like a temporary release valve inside a larger weakening structure. And once that happens, the downside opens up in layers. First, you start talking about that low 50s region. Then, if broader risk markets really crack, you have to admit the ugly possibility that Bitcoin could revisit something starting with a 3. Not because it must, because it can, and that's the part a lot of people don't want to hear. They want clean certainty. Up only, down only, one chart, one arrow, one prediction. But real markets don't behave that way. They pulse, they fake out, they overshoot. They break out on one time frame while quietly deteriorating on another. That is exactly why this moment is dangerous and useful at the same time. Here's how I read the bigger picture. The market has had multiple chances to prove it could fully reclaim control, and each big recovery leg has eventually run into overhead pressure. That doesn't mean the asset is dead. It means the burden of proof is still on the bulls. Until Bitcoin clears major resistance and then actually stays above it, you have to respect the possibility that this is still a rally inside a larger cooling cycle. Now let me add something the simple chart crowd misses. This market is no longer just retail traders with laser eyes and a dream. It is increasingly wrapped into the traditional system. From recent market updates, regulated products tied to Bitcoin, Solana, and XRP have expanded, and more filings have continued to show that large financial players want easier brokerage-style exposure to crypto. That does not automatically make prices go up tomorrow. But it does mean the old argument that crypto sits completely outside the mainstream system is a lot weaker than it used to be. And that can cut both ways. On one hand, more institutional plumbing can help absorb volatility and deepen participation. On the other hand, once an asset becomes more integrated into the wider risk machine, it starts behaving more like the wider risk machine. Translation: if stocks wobble, if liquidity tightens, if macro fear comes back, crypto can get dragged around with everything else. That is one reason I'm not willing to look at a short-term breakout and declare the all clear, especially now, because the broader backdrop is not exactly calm. Risk sentiment has been swinging around geopolitical headlines, oil shocks, rate expectations, and earnings season. There's also another Fed meeting coming up later this month, and markets are clearly still trying to figure out whether policy stays restrictive or starts bending again. That matters because crypto loves liquidity stories, but it also hates growth scares. So if you get sticky inflation and softer confidence at the same time, that's not the clean tailwind the moon crowd pretends it is. That is why I think the cleanest approach is not ideology, it's flexibility. If you're trading this, you can be constructive near term and still be skeptical bigger picture. Those are not contradictory positions. They're adult positions. You participate in the upside while it's there, you respect support while it holds, and you refuse to turn a trade into a relationship. Because the moment traders fall in love with a candle, the market starts charging rent. Now let's talk about Ethereum. Ether is trying to stabilize in the low to mid 2000 range, and that matters because it keeps the short-term structure from breaking apart. There's a support shelf around the low twos that I would not want to see fail if you're leaning bullish near term. If buyers can keep that area defended, then a move through the mid twos can open the door to another push higher, maybe into that upper twos neighborhood where resistance gets a lot heavier. According to the latest publicly available pricing pages, Ether has bounced back toward the mid 2000 area, which fits the idea that the short-term pattern still has life. But again, same warning. A constructive short-term setup does not magically erase the larger uncertainty. Ether has had periods where it looked ready to turn the corner, only to stall once it ran into overhead supply. That's why I would treat strength as tradable first and trustworthy second. And there's a second layer here people ignore. Ether is not just fighting its own chart, it's also fighting expectations. When activity is booming, people call it the backbone of the digital economy. When activity cools, people suddenly rediscover every reason to doubt it. So yes, it can rally, yes, it can surprise. But it still has to prove it can convert a bounce into a trend instead of just another burst of relief. Last month, a major bank cut its forward targets for both Bitcoin and Ether after legislative momentum around crypto stalled, which tells you the optimism story is still fragile. Now let's move to Solana, because this one gets people emotional fast. Solana has been showing some short-term strength too. Price has clawed back into the mid-80s, and the nearby support zone under it is pretty clear. If that band in the high 70s to low 80s keeps holding, then the short-term bullish case stays alive. If it cracks, the air below gets thinner in a hurry. Official pricing and regulated futures pages both show Solana trading in roughly that mid-80s neighborhood, which lines up with the idea that this coin is at an important line in the sand area, not in some carefree open field. What I like about Solana here is simple. It moves. When it catches momentum, it really moves. What I don't like is also simple. It can give back a lot of ground very quickly when momentum fades. So if you're trading it, great. But you'd better know where you're wrong before the market tells you in capital letters. And here's a fresh wrinkle. The institutional footprint around Solana is not theoretical anymore. You've now got more formal product structures and filings built around it, which means more attention, more access, and potentially more volatility around headline catalysts. That can be bullish over time. It can also mean bigger emotional swings when traders start front-running product narratives instead of respecting price. Then there's XRP. This one actually has one of the more interesting short-term setups because it's been pushing around the low $1 area and trying to build on that. If it can keep pressing, there's room for another leg higher before it runs into a more serious ceiling. Public pricing pages show XRP around the low 130s today, and regulated XRP futures are trading in roughly that same zone, which tells you this isn't just a random altcoin fantasy chart anymore. There is a real market there, and traders are clearly watching it. That still matters plenty. But I want to challenge one easy assumption here. A lot of people see a cleaner short-term structure on XRP and jump straight to the conclusion that it is somehow safer than the others. I don't buy that. Cleaner does not mean safer. It just means cleaner for now. If the lower support gives out, this thing can deteriorate much faster than the optimistic crowd wants to imagine. That is why a bullish setup should make you alert, not lazy. And this is where people usually blow it. They see one breakout and assume every coin deserves the same confidence. No. Different charts carry different quality. Bitcoin is the weather system. Ether is the pressure test. Solana is the speedboat. XRP is the headline magnet. They can all rise together for a while, sure, but they do not all carry the same weight when the tape gets ugly. If Bitcoin loses its footing, the rest of the board usually gets a whole lot less brave. That's why profit-taking matters here. Not because you're scared, because you're professional about it. In a market like this, the smartest move is often to sell a little strength into excitement, hold some exposure in case the move keeps going, and keep your invalidation levels brutally clear. If you wait for perfect certainty, you'll be late. If you ignore risk because you're excited, you'll be punished. The sweet spot is right in the middle. And remember, markets love to hurt the largest number of people possible. They can push just high enough to trigger breakout chasing, then reverse. They can dip just low enough to force weak hands out, then turn back up. That is why discipline is not some boring side note. It is the entire game. So what's the real takeaway from all of this? Crypto looks short-term constructive. Bitcoin can still squeeze, Ether can still grind, Solana can still run, XRP can still pop, but none of that forces you to forget the larger risk sitting behind the curtain. And frankly, that curtain matters more than the cheering section on social media. One of the biggest mistakes people make in markets is assuming the next move and the final move are the same thing. They're not. Sometimes the next move is the bait. That's why I'd rather be nimble than loud. I'd rather take the clean part of a move than try to become a legend in a comment section. Let the market prove the bigger breakout if it wants to. Until then, trade what is in front of you, not what makes the best thumbnail. And let me say this too, because somebody needs to. The bearish macro case is not a religion either. If Bitcoin powers through the upper 70s zone, holds the breakout, and drags the rest of the complex with it while macro conditions improve, then the bigger bearish thesis weakens. You do not get extra points for clinging to a dead idea. A smart trader updates. A stubborn trader explains. There's a big difference. So yes, I'm open to near-term upside. And yes, I still think the larger structure deserves caution. That's the balance. That part matters more than ever. That's the edge. And that's also why this environment is actually better for disciplined traders than for emotional investors. Because when the market is giving you short bursts inside a bigger unresolved picture, the winners are usually the people who can hit singles and walk away, not the people trying to call the exact top, the exact bottom, and the exact future of civilization before lunch. One more thing. If you're successful, share your success story in the comments so others can stay motivated. And while you're down there, tell me this. Do you think Bitcoin tags that around 80,000 area first? Or do you think the macro pressure shows up early? And which one has the best short-term setup right now, Bitcoin, Ether, Solana, or XRP? Because this next move is going to reveal a lot. If the support holds, traders will get their push. If the resistance wins, the tone changes fast. If macro pressure rolls back in, people who chased late are going to learn a very expensive lesson. And if the bulls actually break the larger ceiling, then a lot of very confident bears are going to have to do some soul searching. That is why I'm watching this stretch so closely. Not because I think one candle decides everything. Because the reaction around these levels tells you who is in control. So stay sharp, stay flexible. Respect the near-term strength, but don't forget the larger trap that could still be sitting there waiting. This is an educational breakdown, not personal financial advice. I'm sharing how I see the board so you can think more clearly, manage risk more honestly, and make your own decisions like an adult.